Hi everyone,
Okay.
welcome back to Be Rich. It's me, Vinod, here with Shashwat, recording remotely. I haven't managed to catch him, so it's been some time since I brought him to the channel. But he had some free time today and he said, Uncle, can I come on? I said, please do. Because he was reading an interesting article we were talking about offline. And I thought that article is very, very relevant to what is happening in the market, how we as investors should approach this market. And I think it's a very timely piece of advice Shashwat has for all of you. Without letting the cat out of the bag, I'll allow Shashwat to walk us through what he read.
Yeah. Well, I wouldn't say it's more of advice, but a lesson for myself. And I figured that as I move along my investing journey, it's important that I share some of the good stuff that I come across with our audience who are also moving along their investment journey along with me and you. So it's more of a learning that I've come across, which I want to put across on Be Rich. So this article, or rather, it's not an article, but more of a piece which has been written by an investor who I follow. This person's called The Rational Walk. We've talked about a lot of his works before, and I want to springboard off of the piece which he's written to, in general, discuss this idea of dollar cost averaging for investors. For those of you who are not familiar with what dollar cost averaging means, it's basically SIPing. You have a fixed sum of money over a bunch of years and you invest that fixed sum monthly, regularly, consistently every month of that year for the next decade, 2 decades, 3 decades, and onwards and upwards. And you can increase that fixed sum as and when you can save a little more, and you can possibly adjust it according to inflation or even a little bit more than that, so that you keep your inflows into your investments at a steady pace, so you don't find yourself with a corpus that is a little lower than what you had expected over the next couple of decades. But anyway, I digress. The main point of this piece was to talk about the value of dollar cost averaging or a systematic investment plan, and is also about how there is an alternate approach to investors like you and me, where we like to get our hands dirty, we like to look at a balance sheet, we like to look at numbers. So there's a method there which my other uncle has talked about a lot, and that's what he follows in his practice, and which he's instilled in both of us, which is basically what the Rational Walk talks about. And that idea is that SIPing goes for entire index funds, like an entire Nifty 50 or an entire S&P 500. There's another approach. For those of you who like to read balance sheets and those of you who like to analyze cash flow statements, it may make sense to do that. Find a company that is solid, which you feel very confident in. For example, an ITC, a Tata, whatever that company may be, and you dollar cost average or SIP within that basket of stocks. So you pick your own basket which you think you will be very confident with, and you dollar cost average on that. And the stock which the Rational Walk picked was Berkshire Hathaway. Even during he's been doing this since 2000s, since the early 2000s. So during the 2008 crash, he was doing it in Berkshire Hathaway, and in 2011 Berkshire Hathaway was actually trading below book value. Can you imagine it? Berkshire Hathaway was trading below book value, and he dollar cost averaged then too. So the point I'm trying to make here is that the Nifty 50 of course doesn't have such great companies. I mean, not all the Nifty 50 companies are so great. Some are fundamentally weak. Some you may not ideologically be aligned with. There are many reasons or factors for which you might be willing to dispose of certain companies in the Nifty. I mean, it's 50 companies for Pete's sake. I mean, 50 companies, not everyone is going to be a hit among every person. But he says that pick the 10 or 15 out of those which you will give you confidence or inspire confidence, and you can dollar cost average in those companies. So what do you think about this idea?
I agree. This is exactly the effort all of you, me, and my brother have been trying to do since the beginning of the year, which is the Tiffin Coffee Rage Challenge, some call it. We call it the 52-week challenge. Whatever name you want to stick to it, to motivate yourself. It's basically this, that what you rightly said. Take a list, your patas list, or whatever list you call it, and you have these companies. And then you get into the market every day, and you be consistent. The trick to this whole thing, it only works is if you're consistent. If you're doing cost averaging or you're not doing cost averaging, but if you're consistent in your investing and you're investing in quality stocks, returns will definitely happen. And that is the lesson which is the most important. The problem is life happens and we allow noises to get into our heads, and then those noises take us far away from what we need to do at that moment. And this happens to all of us. And this is what leads to, like my friend Mr. Arun behind the camera, why he struggles to invest is because he's constantly listening to the noises in his head. And he's saying that, no, sir, I'll wait till the market really corrects, then I'll invest. If you do that, you'll either be waiting forever, or the day suddenly the market does correct, decides to correct, because it doesn't correct on your schedule. It corrects on its own timetable. And when that happens, you may not have the money because you decide to go on a trip to Ooty or Kodi somewhere and you have blown all the money, the 30,000 rupees you had set aside to invest is blown and you've gone through it. And on that specific day, you won't have the money. But if you do this, what Shashwat is saying and recommending, where you invest in steps and you keep consistently hitting the ball, what happens is no matter market is up or down, you're investing and you keep plugging along and you keep chugging along. And lo and behold, in a long stretch of time, conditions keep improving, markets keep improving, technology keeps coming. Yes, at this current moment, geopolitically, macroeconomically, even within India, you might be finding things turbulent, maybe not aligning to your ideology, whatever it is. But these things keep on changing. We were not here 5 years ago. 5 years from now, we will not be here. We will be somewhere else. Where it doesn't matter, because as long as you consistently invest, you will get to your goal of becoming financially independent. And that is everyone's goal, is to be in a position in life where money or wealth is not something you worry about. It gives you that freedom to think about other things in life. So I agree with what Shashwat is saying and what the Rational Walker is saying. He is very fortunate to have the opportunity to start SIPing in Berkshire Hathaway. I'm sure his portfolio is looking amazing right now.
Oh yeah, definitely. That would be correct, because for those of you who are at home and they have Google at their disposal, I would suggest quickly pausing this video or keep this running and go to Google and search up Berkshire Hathaway Class A or Class B. Then go on Google and then press the max timeline, and then you can track how much Berkshire Hathaway was trading in the early 2000s and how much it's trading today. So that will give you the returns which he's made during that period. And if you use the compound interest formula and you put in the principal as that starting point and you put in the end point and solve for the rate of interest, that will give you the CAGR of what sort of return he's made.
And if you don't know how to do that, and if you don't know how to do that like me, you can just use a formula online or even use ChatGPT to help you out.
Yeah, so by all means, you can use ChatGPT for it. But my main point is that there's no dividend yield. So this is going to be a very simple calculation, straightforward calculation. Uncle Warren looks out for the little guy like you and me. So
yes, and those of you who did miss out in Berkshire Hathaway, don't worry. Opportunities again will transpire, and the way the world works is it's like that. It's like a snow globe. Someone constantly keeps shaking it, and that dust storm gives opportunities again. So the point is to be consistent in this investing is so you're ready when that opportunity comes, because you've been batting every day.
There's something which you and me and Rupesh have been planning for Be Rich, which is probably going to come out next week, which is that we're going to be analyzing Japanese and American companies, and we're going to be doing valuations on them, and we're going to basically put out in a video format what we've been thinking about, companies which we think are in the value range, or if we think there are great companies that aren't in the value range, we talk about those too. And that video is going to be coming out next week, and there's a particular Japanese company which has fallen into our radar, which we have analyzed and which we're going to put up as a video. So I mean, the point is that there's opportunities everywhere, even in a market that seems to be overvalued in a lot of places. Opportunities are everywhere. It took us, after a bunch of research, it took us a couple of days to come up with this opportunity, and we're going to be discussing it, of course. But these opportunities are around and they're waiting to be picked up by investors, small-time investors like you and me. What do you think about this?
I agree with this, as long as you know what you're doing. Shashwat knows what he's doing. He knows how to look at a balance sheet. He knows how to look at financials. He knows how to correlate.
I'd like to say that I have the advantage of having an uncle who knows his stuff.
Okay. I'm talking about lay people like me and my tribe, Shashwat.
Please.
You may feel... No, one second. let's stop the truck, okay? None of us have studied economics in Korea. None of us are there studying what you're studying right now. Most of us who are watching this have not had that advantage. And we have not had, because of whatever we have studied, we're doing a job, or, life being like me, like being a full-time dad, takes us away from the opportunity to study this. So you have the opportunity. So you are more skilled at it. You may not want to, talk about it and allow it to dwell on your mind, because then you feel imposter complex. I get that. But from where I sit and my group sits, yes, you do have a skill and a knack, right? Which is better than us. The reason is I want to give it out as a warning, because I don't want people to assume they are as you, because we are not. And there's a huge ocean of difference between you, Anand, and us, because we cannot just randomly pick up a company, a small cap, a micro cap, and look at randomly some financials and decide to say, okay, there's value here. It doesn't work like that. So, yes, if you are interested in doing what Shashwat and my brother do, learn. Spend time studying, spend time reading, practice, have discussions, talk to like-minded people, do that analysis together, and try to find value. Take your time, learn the skill. Then what Shashwat says is true. You may definitely, rummage through and look at finding value here and there. But if you take this approach, like your first time you're seeing this video and you're feeling very impressed with what Shashwat is saying, and you're like, hey, I can do this too. No, you cannot. That's where I want to say, yes, you can learn how to do it. I'm not saying it's some genius skill. It's not a genius skill. It is a skill which can be learned by anybody and everybody. So, it's not like I'm a prodigy at it. Stock picking is something you can learn, but please learn it, before randomly watching some YouTube or Instagram or seeing some comment and deciding to say, okay, I'm going to do this. That's what leads into problems. So
that's true.
What Rational Walker works, as long as you are investing in quality stocks. And my brother keeps saying this in all the videos over and over again. He's like, see, I am telling you to recommending that you invest in quality stocks. And the reason why Rational Investor kept on investing again and again in Berkshire Hathaway, even when market was beating it down, like he said, was trading below book value, is because the guy running it, he believed in him. This applies to all the companies my brother is looking at and Shashwat is looking at. They look at the guy running the company and they say, okay, no matter what Mr. Market feels, I like the way this guy runs the company. And that is fundamentally important to any investment you make, because you are not running the company. So the business may be amazing, the product may be amazing, but you got a clown running it, like what's happening in the US right now. You are going to be in a world of mess, right? I don't agree, with actions being taken, then I cannot be investing in it. The company might be an amazing company. It might be $1 billion company. Suddenly the owner of the company loses his mind. You can't invest in it. I'm sorry. Because he'll burn the building down and he'll burn you with it. So that is fundamentally important. Yeah. So that is important when you keep this in mind. Yes, research. Yes, pick, But if you do not know this and you're in the process of learning and you have not done this, follow Shashwat's first advice, which is, just pick up something passive. Like, you take a company in the Nifty 50. Because if it's in the Nifty 50, you can be rest assured it's a quality stock. So there are 50 companies for you to choose from, You don't have to pick all 50 because they won't be in your tiffin coffee range, as we call it. Maybe out of the 50 companies, only 10 companies are in your tiffin coffee range. And you can just target those 10 companies as you're learning and creating your own list, Because rest assured, at least you're passively investing in stocks. And if you're older like me and you do not know anything, then I would suggest you stay passively in the mutual funds. You pick the Nifty 50 passive fund and you invest in that. If you're young like Shashwat, you can take on a bit of a risk and invest in the stocks directly. But if you're old like me, you're mid-40s pushing to 50s, then I would say first learn to passively invest in mutual funds such as the Nifty 50 fund, or do gold, passively keep investing in gold till you learn the skills which are required to know if a company is good or not, and then invest in stocks. That would be my caution to this.
Yeah. Just one thing I want to say, that my economics degree by no means makes me a better or worse investor, because I don't want people to think that that's a barrier of entry. I want people to know that they can be a good investor even without having an economics degree. Even if you're an engineer. Like
for Shashwat, actually, both my brother and me are both engineers. The reason why I told Shashwat is different is because Shashwat, before he studied economics, he realized he wanted to be an investor. So then he decided to study economics to help him align and become a better investor. So his journey to investing started much before he decided to do economics. So that is where it differentiates. Most of us who studied economics did not study it thinking I'm going to become an investor, so I'm studying economics. You just took it because it was something you didn't have a choice or you thought was an option, so you did it. Now you want to be an investor, like Shashwat correctly said. That degree is useful, all right, but it's not going to make you an investor per se. That is a different skill which you have to learn and hone, which you have to do, which is very true.
Yeah, and I've been lucky enough to be blessed with two uncles who also do the same thing that I'm interested in. So the main point here is that you'll see when the video comes out, but the valuations are based on fundamental analysis and it's based on critical thinking. And if we're able to keep a sane head, we're able to be rational when other people are losing their minds. For example, the Japanese company we're going to pick up next week, it's going to be a company that is mired around a lot of negative press because people think it missed the bus on a certain change in its industry and they've put it behind. And if you've watched our videos before, we try to pick out of favor stocks because when a stock is out of favor and it's being battered is the best time to be able to pick it up. You'll get prices on it which you won't get when things turn around, because in good times everyone is willing to buy that stock, whereas in bad times, I'm not saying that every stock that goes through a bad time is at a great valuation and you need to buy it, but there are certain companies, certain great companies which go through troublesome periods and then they end up getting out of it, and you need solid fundamental analysis to be able to differentiate the 99 companies that are doomed and that one company which is going to recover from its lows. So anyway, but yeah, that being said, regardless of whether you want to pick individual stocks, dollar cost averaging builds that discipline with that that 52-week challenge which you've been promoting on Be Rich and started the initiative. I think that's very important. And as soon as I saw this piece, I actually wrote to my uncle saying that, look, this is basically the 52-week challenge extrapolated by a couple of decades, which is what you plan to do. You plan to do the 52-week challenge every year. So maybe you can reinforce the 52-week challenge.
If I told everybody it's a 520-week challenge, everyone would have said what, and no one would have been enthusiastic about it. So I broke it down into chunks which are digestible. So first, let's climb the first hill. Then we'll get to the other 9 hills as we get through them.
You're like a running coach training your students to run a marathon with you.
Yeah, and I'm running with you guys because that's the one way to keep it honest, and it keeps me motivated too. One of the best ways to motivate yourself is to call yourself out. They do say this for weight loss. They say this about endurance or any sport you want to be getting better at, reading. Call yourself out. Put yourself out there and say, I'm doing this. Even quitting smoking, they say that. Tell everyone you quit smoking. So that way that you kind of feel, the pressure is on you to deliver this because you've told everybody about it. So it's a great way. I would say, if you join this group, be vocal about it. Say, yes, I've joined. I'm trying to invest. I'm trying to create myself some wealth and get myself out of a situation which I don't want to be in. Makes sense. But that said, like Shashwat said, we gave you a lot of information on this video, which is like we're saying yes, then we're saying no, then we're saying up, we're saying down. Yeah, because stock investing is a social science. It's not a regular science. There are no equations or something to solve here. There's no black and white. Unfortunately, it's like that. It delves into the world of the mind and emotions. That's why I spend a lot of time talking about emotions and mindset, which is what's very fundamental in investing. So keep all that in mind. At the end of this video, what I want you to take is, I want you to feel motivated into learning. That is the essence of this video. It's not to tell you what to buy, what to sell. It's the weekend, you have some time off. So you should feel motivated, like, saying, let me spend at least a few hours trying to get my mind in order and start reading about this and learning about this is what I would want from the essence of this video. Anything else you want to add, Shashwat?
Nothing else. The only one thing which I want to just mention as a side note, which is that in the Substack, we've updated an article on the budget, which looks at what has been done, what could have been done, and what it means for the economy and for the individual person, for the common man, as they say. And our company analysis will be posted next week along with the video, which will come out sometime next week, which we'll keep you posted on. But either way, I hope all of you subscribe to the Value Observer because we do put a lot of effort into the articles we post there.
Yes. do subscribe and support us and support his team, because every encouragement they get from you will encourage them to do more work for you and help you out, and also help you discover some real gems which are hidden in the market, not only here in the US and in Japan. As I was saying, thanks for watching the video as always. Me and Shashwat hope you have a wonderful weekend, and be safe out there in whatever enjoyments and merriments you do make for yourself. Take care of yourself, and me and Shashwat will see you again in another video somewhere else about something else. Nothing else more to say. Thank you for watching Be Rich today. Bye.
Thank you.